one of the big elements of our property acquisition mandate is how we leverage. Now, we totally believe in leverage as being a fundamental to driving the dollar further, but there are good ways and there's bad ways you can do it. There's foolish ways of leverage and there's quite sophisticated ways to leverage. So I just thought I'd touch on a few points that we are starting to experience, some questions we're starting to have from our investors, and then also how we're responding to this environment. So let's start at the top. Leverage is borrowing money from another person or entity, in most cases a bank. So we need to ask ourselves, what does the bank want to see? And if we can answer the questions there, if we can give the bank the satisfaction it needs about us, about the property, about the tenants, then what we're doing is we're allowing the bank to make an easy decision. So in times of difficulty, we don't want to be pressurizing our banks and cornering them into a hole to give us terms that are unfavorable. We want to do exactly the opposite. We want to spend as much time as we can preparing the information, getting all our ducks in a row, getting a really moderate gearing ratio, and approaching our banks with sophistication. So there's three real things which collectively make up the terms that you experience with your banking party or your financing party. So the leverage that you get. The first one is, okay, the asset itself. So is the asset primary or secondary? Now, I've gone through that in previous videos. But the bank's going to ask all those questions just like we should be doing. And if we've done our due diligence correctly, we should be able to answer all of those questions that the bank may have. Primarily, we want to go for core assets. The second thing the bank will want to know is, what is your intended leverage? As in, what's your loan to value ratio? How much leverage do you want from the bank? And what's your appetite? So it's very fair to say that our appetite is moving down the spectrum, whereas we were very comfortable borrowing at 60% at one point in time. We've now brought that back to 50%, maybe 55% loan to value ratio, and we may look to go below that. Not only does it allow you a bigger equity stake in the asset, but it allows the bank more comfort that you've got more invested. So that's a fundamental which you'll see playing out in our investments and syndicates to come, in that we'll take a more conservative leverage. The third thing which the banks use to dictate their terms is the sponsor. Now, the sponsor is us. The sponsor is who is the borrower of that money. Now, obviously, Joe Bloggs can walk in and try and buy a $50 million asset with enormous leverage, and the bank will say, yep, I like the asset. Yep, I like the leverage. But who are you? What's your track record? How do we know you're going to be able to manage this asset the way that you need to in order to create your outcome and pay us our interest? So that's the other question that we want to help the banks. We want to play in markets, and we want to acquire assets that we are familiar with, that we have history, that we have a really fantastic track record of results. So the bank knows that when they're supporting us, yes, they're supporting the assets we're buying. Yes, they're supporting us at our chosen appetite of leverage. But thirdly, yes, they're supporting our ability to create the results we want. They're supporting our strategies, our asset management strategies. So they know that along the journey of acquisition and ownership and then divestment, that we're able to manage outcomes along the way. So that's the part that we are becoming very forthcoming with. We want to be really transparent with our banks and take them along that journey with us. The more that our leverage partners, and I keep saying banks because largely they are, the more we can bring them along the journey of what we want to achieve with our acquisitions, the more capable they are of giving us terms and finance that are very relevant, and they suit the demands of the property, and they allow us to do what we want to do. So those are the three things that we're working on. Firstly, the asset, we want to be absolutely core. Secondly, our leverage wants to be more conservative. So we're bringing that down to about 50%. And then thirdly, we want to make sure that we're doing everything we can to furnish the banks with the information they need to believe in our strategies, to believe in us as sponsors. Now that all translates to effectively investor return. It translates to the value that the investors get, the result that the investors get. The one thing which I haven't mentioned, but it's a cornerstone of every one of our syndicates, is that we only want to leverage on a non-recourse basis, which means that when the banks are issuing us funds, the leverage and the LVR, as in the loaned funds that they give us, are secured, but they are only secured on the assets themselves. So it means that the bank isn't taking a personal guarantee from us or any other of our investors. They're actually comfortable enough with the asset and comfortable enough with our chosen LVR and comfortable enough with us as a sponsor and our ability to manage that asset that they will secure their loan with the asset alone. So they will secure the asset purely by the assets that are underpinning that loan. That's a fundamental of our investment mandate, and it gives our investors huge peace of mind when you enter times of uncertainty. So those are the three things in a nutshell there, and then a cornerstone principle of our investment strategy, which I just wanted to touch on and be really transparent about.